2026 is the year you finally stop watching money videos and start making money moves. This is for you.
Most beginners fail at investing not because they're lazy, but because they start in the wrong place. And one wrong move early can delay your progress for years.
Welcome to Paradigm Shift Money Lab, where we break the money rules you were taught and replace them with how money actually works.
Today, I'm showing you 5 beginner-safe investment lanes you can use in Nigeria in 2026. Even if you're starting small, no hype, no gambling, just clarity.
Stay till the end because the last option is where long-term wealth quietly compounds. Investment number 1, high-yield savings, the foundation. Let's start where smart investors actually start. Before risk, before charts, before hype. A high-yield savings account is not about getting rich.
It's about protecting momentum.
Here's the paradigm shift. Savings isn't useless. Idle savings is. Imagine this. You keep 300,000 Naira in a regular bank savings account. 6 months pass. The balance is still 300,000 Naira, but transport fares have increased, food prices have jumped, and electricity tariffs are higher. Your money didn't move, but your purchasing power did.
Inflation steals quietly. It doesn't announce itself. This is what idle savings does. It looks safe while slowly leaking value.
Now flip the situation. That same 300,000 Naira sits in a high-yield savings option that pays interest weekly or monthly. You're not trading, guessing, or watching prices. Yet your balance grows gradually. Your money stays accessible and you're resisting inflation instead of surrendering to it. This is how disciplined money stays ahead of careless money.
As a beginner, your biggest asset isn't capital. It's flexibility. An opportunity appears. A Treasury bill window opens or a money market fund offers better rates. If all your money is locked or already spent, you miss it. But if your cash is sitting in high-yield savings, you can move immediately. Wealth favors people who are ready, not people who are hopeful.
Maybe you're starting small. That's exactly the point. You save 10,000 Naira weekly. Week 1 becomes 10,000 Naira. By week 8, 80,000 Naira. By week 16, 160,000 Naira. Instead of sitting idle, that money earns while you build consistency. Small money that earns is more powerful than big money that waits. The hidden benefit most people miss is behavior. High-yield savings trains you to separate saving from spending, reduce impulse decisions, and stop rushing into risky investments. It builds financial discipline before financial risk.
High-yield savings doesn't make you wealthy. It prevents you from sabotaging future wealth.
And remember this.
If you can't grow money safely here, riskier investments will only magnify mistakes. Master the foundation first. Then, move up the ladder.
Investment number 2, money market funds, professional control. This is where beginners get a serious upgrade, not by taking more risk, but by handing control to professionals. Money market funds work by pooling your money with thousands of other investors and placing it into low-risk, short-term instruments like government securities and high-quality corporate debt. Instead of you worrying about where the money goes, trained fund managers handle the decisions. Key insight: your capital stays stable while returns move slightly up or down. Here's a practical example.
You have 500,000 Naira that you won't need for the next few months. Leaving it in a normal savings account does almost nothing. Trading stocks with it feels risky. So you place it in a money market fund. Nothing dramatic happens, no price crashes, no daily panic. But every day, interest quietly accrues. At the end of a few months, your balance is higher, not because you were lucky, but because your money was working in the background. Real wealth often grows when nothing exciting is happening. Now imagine inflation headlines everywhere. Interest rates change. The news feels heavy. With a money market fund, you're not reacting emotionally to headlines because your money isn't exposed to wild swings. That's the emotional advantage beginners underestimate. Think of this like hiring a pilot instead of flying the plane yourself. You're still on the journey, but you're not touching the controls.
Another example.
You're saving toward a goal, rent advance, school fees, business capital. You don't want surprises. A money market fund allows your money to grow modestly while staying relatively predictable.
This is where stability beats excitement. One of the biggest benefits of this lane is discipline. Because returns are steady and capital is protected, you're less tempted to withdraw impulsively or chase risky alternatives.
This makes money market funds ideal for
Emergency funds that should still earn,
short-term goals within the year,
beginners building confidence. Paradigm shift. Not all investing is about maximizing returns. Some investing is about minimizing regret. And that's why this lane matters. If market headlines make you nervous, this lane lets you sleep peacefully.
Once you're comfortable here, once you've seen money grow without stress, moving into higher risk investments becomes a choice, not a gamble. This is professional control doing exactly what it's supposed to do.
Investment number 3, Treasury bills, government-backed safety.
Treasury bills are one of the simplest ways to invest. You lend money to the government for a short period and the government pays you back with interest. No guessing.
No price swings,
No drama.
Why do treasury bills matter in 2026? Because high interest environments reward people who can wait. When interest rates are elevated, patience becomes profitable.
Here's a practical example.
You have 1 million naira that you won't need immediately. Instead of leaving it idle, you invest it in a 90-day treasury bill. From day one, you already know
How long your money will be locked,
how much interest you'll earn, when you'll be paid.
at maturity, you collect your capital plus interest, exactly as promised.
Predictability is a form of peace. Treasury bills typically come in 3 common tenors: 90 days for short-term parking, 180 days for medium-term planning,
365 days for those willing to wait longer.
Each option rewards patience differently, but the rules never change.
Another example. You're saving for a known expense, rent renewal, school fees, or a business upgrade in 6 months. You don't want to gamble with the money, but you also don't want it sleeping. A 180-day treasury bill fits perfectly. Your money works quietly while you focus on life. When the timeline is clear, the risk should be low.
One of the biggest advantages of treasury bills is who you're lending to. You're not lending to a friend, you're not lending to a company,
You're lending to the government.
That's why treasury bills are considered one of the lowest risk investments available. Treasury bills are not exciting, and that's the point. They protect capital. They reward discipline.
They remove emotion from decisions.
In a world full of noise, treasury bills teach you to respect process over impulse. This is where disciplined money beats emotional money. Every time. Once you understand treasury bills, you stop chasing uncertainty. You start structuring certainty.
Investment lane number 4. Commercial paper, controlled risk, higher reward.
Now we move one step up the ladder, not into gambling, but into calculated risk. Commercial paper is a short-term loan you give to a company. Instead of lending to the government like treasury bills, you're lending to large, credible businesses that need temporary working capital. In return, they pay you higher interest.
Here's the key difference.
With higher returns comes higher responsibility.
Not all companies deserve your money.
Smart investors don't chase returns. They evaluate credibility. Let's break this down with a practical example.
You have 2 million naira set aside that you won't need for the next 6 to 9 months. A commercial paper opportunity appears offering a higher return than treasury bills.
Before jumping in, you ask the right questions.
Who is the company?
Is it well known and established? Does it have a strong financial history? A solid company with a track record of meeting obligations is very different from an unknown name promising unrealistic returns. The return is attractive, but the issuer matters more.
Commercial papers are usually short-term, often around 6 to 9 months. This makes them suitable when you're comfortable locking funds for a defined period, not indefinitely. Another example.
2 commercial papers are available. One from a well-established company with a slightly lower rate. One from a less-known company offering a much higher rate. A disciplined investor chooses stability over temptation.
The highest return is useless if the money doesn't come back. This lane works best when you already understand how money behaves in safer investments like savings, money market funds, and treasury bills. By the time you reach commercial paper, you're no longer guessing, you're comparing. Commercial paper is ideal for investors seeking better returns without long-term lock-in, people comfortable analyzing company strength, funds that are not needed immediately.
Controlled risk means knowing why you're being paid more.
When done right, commercial paper rewards patience, research, and restraint, not impulse. And that's why this lane sits above treasury bills, not beside them. Move up only when you're ready. Investment lane number 5, exchange traded funds, long-term wealth engine. This is where patience compounds into power. ETFs, exchange traded funds, allow you to invest in many companies at the same time through a single investment. Instead of trying to pick the next big winner, you spread your risk across an entire market or sector. You're no longer guessing which company will win. You're betting on progress itself. Let's look at a practical example. Imagine you want exposure to large global companies. Instead of choosing just one stock and hoping it performs well, you invest in an ETF that tracks a broad market. Inside that single ETF are dozens or even hundreds of companies. If one company struggles, others carry the weight. If some underperform, others outperform. When one company fails, the market adjusts. Your investment survives. This is why ETFs are powerful for beginners and long-term investors. Now let's talk about starting small. You don't need a huge amount to begin. Whether you invest the equivalent of a few dollars or more, the system works the same way. You buy a portion, and over time, that portion grows as the market grows. Consistency beats intensity in long-term investing. Returns with ETFs fluctuate. Some years are strong, some years are slow. Occasionally, markets pull back. That's normal. Here's the key difference. Long-term investors don't panic during drops. They continue investing.
Example.
2 people invest in the same ETF.
John panics when prices drop and sells. Ademola stays invested and keeps buying over time.
Years later, Ademola benefits from a recovery and compounding. John keeps restarting from zero.
Time in the market matters more than timing the market.
ETFs are best suited for long-term wealth building. Investors who don't want daily stress.
People who understand that growth is not linear.
This lane rewards
Patience, discipline,
emotional control. Wealth doesn't come from guessing. It comes from staying invested longer than fear lasts. When you commit to ETFs, you're not chasing quick wins.
You're building a system that compounds quietly, year after year. That's it. You don't need to do everything at once. Start with one lane, understand it, then stack the next. At Paradigm Shift Money Lab, we don't rush money, we engineer it. If this video shifted how you think about investing, subscribe. Clarity compounds faster than cash. 2026 is not the year to observe, it's the year to execute. Let's build